Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli. Let's get you caught up on where the market is set to close the trading day on another busy reporting season. The CIPO 200 up by 1/3%. The ASX 200 looking a little bit flatter, only up 10 points or 1/10%. 7,663. Of course, earnings season very much in focus. And let's take a look at our three themes of the day. I put Zip dips there because Zip shares are falling even though it has returned to profit. The buy now, pay later company seeing US sales and revenue hitting record levels. Overall revenue up by around 29%. No dividend, which wasn't expected, but shares being sold off along with the likes of Tyro, and we spoke to the Tyro CEO earlier today as well. Mind the gap, another report showing just how much of a pay gap there remains, particularly when you look at some of these lucrative roles, men earning more than 20% more than women. And when you look at, of course, the bonuses taken into effect as well, which is often those more sort of male-dominated themes that pay, industries that pay bonuses, 19%, and this according to the Workplace Gender Equality Agency. So we've got a long way to go. Inflation beat Japan's inflation numbers for a third straight month in January, beating forecasts, holding the central bank's target though at that 2% target. But it does really just keep alive that theme that could we see an end to negative rates from the BOJ perhaps as early as April. All right, let's get you caught across some of the sectors that we saw today. Of course, coal's very much in focus with its numbers. Coal's up 5.5%, Woolies up by almost 1%. Treasury Wine Estate and Endeavour Group doing very well as well. A2 Milk to the downside. When it comes to the tech space, we talked about Zip and Tyro. WiseTech Global, though, having a very solid day today, up by about 7.4%. Looking at some of the real estate stocks, they are all lower. And let's get you caught up on some of the top stories as well, because, of course, consumer staples, certainly the standout sector. Coal's up 5.5%, the best daily gain since the start of the pandemic after it posted better than expected results. Woodside actually rising despite the fact that net profit did fall, but it was less than anticipated, and we had a higher oil price today as well. Woodside cutting its dividend though. Zip, I mentioned, falling along with Tyro, down 13 and 10% respectively. Investors booking profits there after both companies posted better than expected results, and both companies have risen ahead of those as well. Remember, Zip is also the, I guess, furor around this takeover target as well. And speaking of takeover targets, Alumina among the biggest losers, down 5.5%. It swung to a net loss of 150 million US and withheld a final dividend. Let's get all the latest in terms of reporting season. Martin Crabb from Shaw and Partners joins me. We've been talking about your sort of report card view of the reporting season. Where do you sit now when we're towards the end?
Yeah, it's it looks good from afar, but far from good. I think it's a good title that a colleague of ours used in a research report this week. If you look at beats to misses, Juliette, there's probably been 2 beats for every miss. So it's been from a headline perspective, companies coming out and doing better than analysts thought, but we've seen downgrades. So it's like conditions are better in the short term than we thought. We're a little bit worried about the second half of the year. So we've seen about 76 or so of the big companies being downgraded. Their 2024 earnings estimate's been downgraded versus about 60 on the upgrade. So you'd think with the 2-to-1 beat ratio, that would be around the other way. So it's little bit like the Coles result today. It's like the revenue probably wasn't as strong as people would have hoped, but their margins are really good. So those companies that have managed to see the inflation coming and they've managed to adjust their cost structure and they've managed to keep their prices or even put their prices up, knowing there's wage pressure coming through, there's been really good beats on margins all through reporting season. Where there hasn't been a beat is in the outlook statement. So outlooks have been 60% of companies, I think, saw sales deteriorating versus 20% improving. So that's where the downgrades have come from. It's more in the outlook statement. So more of that today, but some big moves today. I think Reece Plumbing up almost 20%. Yeah. WiseTech again on the back of the rally yesterday and the upgrades that come through. So some, I think the last 3 weeks we've used the analogy of a duck swimming across the lake.
We have.
The market hardly moved today, but if you look in the screens, there's up 20s and down 20s all over the place.
Yeah. I know Danny will be sad to be missing today because this is one of her favourite topics. Where have all the builders gone? There's not many of these companies left.
It's really interesting, isn't it, that people have been talking about the M&A cycle will come back as soon as rates stop going up, because basically you can work out what your funding is going to be. When rates are moving, you've got no idea what your funding costs are going to be. So we've seen in the past 2 or 3 months the A, B and C of building, so Adbri, Boral and CSR all received bids, and you could loosely throw Alcoa's bid for Alumina in that as well, in that a lot of aluminium goes into building as well. It's a little bit of a stretch, but so as asset allocators or investment managers, how do we get exposure to the Australian construction cycle? A lot of the big players, traditional players, have got out or looking to get out. So if I think Lend-Lease and Leighton's and all those companies, they're sort of almost not on the boards. Lend-Lease wants to get out of construction. So Boral, CSR, Hardy's is a global player. It's just hard for people to get exposure. So I think what we're going to see is that residual money that's coming out of the sector will just get rotated into a small number of stocks. So I think things like Reece, Reliance, maybe Brickworks, Solpats, these sorts of stocks. But it's just really, it's a big industry. It employs about 10% of Australians, and yet you can't invest it on the stock exchange. It's quite bizarre.
And, the French takeover there as well, getting involved. Let's talk about the macro perspective. You're saying 3 green traffic lights. What are they? Yeah,
so the things we look at for asset allocation, Juliet, are growth, financial conditions and central bank positioning. So in the presentations I've been doing to clients around the country, it's like all 3 of those are green. And normally when they're all green, markets do quite well. So we're not that surprised that the markets are performing quite well. So that setup is the composite leading indicators, the PMI data, the financial conditions index and the shape of the cash futures in almost every country are supportive of equities. The problem is valuation. Valuation looks, it's red light. I mean, you ideally want all 4. You don't typically need all 4 because if there's a really good macro setup, then it's already in the price a little bit. So what is flashing red, definitely amber, but potentially red, is that valuation. The PE ratios, which are a nice, easy way to think about things, 16.5 for Australia, 22 for the US, kind of 17 global. They're pretty big numbers.
Just getting back to reporting season, I mean, you talked about the misses and the beats and all of that kind of thing, but if you were going to just take a broader view of it, and we spoke about this last week, it is a lot better than what people were expecting, but as you say, it's the next 6 months that could be the concern.
Yeah, and for investors, do we worry about this year at all, or do we start thinking about 2025? Because I think the trap you can get caught in is, earnings are going to be terrible in the second half. I'll just hold off buying stocks. But if the outlook for 2025, and this is why, Saint-Gobain, one of the biggest building materials companies in the world, is buying CSR today. It's not because of the 12-month outlook, because there's no houses being built. It's more about what does this look like longer term. So I think the issue there for investors is to say, well, this reporting season is telling us things aren't as bad as we thought, which means interest rates are probably going to stay higher for longer. But the release valve is going to be there. Inflation's going to come down, and we're going to get cuts next year or the end of this year, and 2025 starting to look really, really good. So I think it's difficult, and again, we're talking about this PE being on 12 months forward earnings. What's it like on 18 or 24 months forward? It probably starts to look a lot better.
What does the duck do?
The duck just keeps swimming, doesn't it?
Just keeps swimming.
Just keeps swimming.
A little bit slower perhaps until 2025. Martin, always good to chat. Thanks so much, Martin Crabb from Shaw & Partners. All right, let's get to our stock of the day. It was Coles. We had Ben Clark from TMS Capital and Francesco D'Estratis from Ord Minnett sharing their views.
There's always regulatory pressure, not in every industry. We've seen it in our industry over the last 5 years as well. So it does.
Which is taking its toll.
Yes, and it does take its toll on margin. But the Coles and Woolies, they're big enough to sort of navigate their way through regulatory issues and not incur large expenses. The smaller retailers probably not so much. But I think yes, it's a risk. I don't think the government can impose huge regulatory impositions on the retailers. Otherwise, they're just going to. It'll increase their costs. So therefore, all it's going to do is squeeze their margins, and retailers aren't going to be better off. Consumers aren't going to be better off for it.
Really. Yeah.
Like Amazon, etc., they are continuing to grow very aggressively in this country.
that would be the biggest free kick for an offshore multinational that you could probably give if you did do something there. So it's complicated. And I think it was more Brad Banaducci, like that. It was not well handled, that last little bit, but he was actually really well regarded in the market. It's easy to forget Woolies was in a lot of trouble when he took over. They'd had a terrible time. And I think he did a great job righting the ship and returning the business to growth. And I think it was more the market was sort of disappointed he was moving on.
Well, just a programming note that our annual subscriber survey is open until March 11th. And of course, you can join here, get in the draw to win $5,000. We'd really love it if you could take a few minutes and fill it out so we can make ausbiz better for you. And to sweeten the deal, that's not what you want when you fill in that survey. The anchor's sneezing. But to sweeten the deal, someone is going to win a managed investment portfolio from MPC Markets worth $5,000. And there are other prizes too. Go to ausbiz.co/survey24. Let's get you to the market leaders though today. Reece, they're out with its numbers. Martin touched on those. I spoke to the Helia Group CEO earlier. She was pleased with their results. Telix, WiseTech Global, Coles all looking good. To the downside, Johns Lyng, a wee bit nano, Helios, Alumina and Block. And having a look at the small cap leaders and laggards, Step 1 is there again, up by over 12%. To the downside, we have Articor, Silk Logistics, DGL, all coming under pressure today. So what is happening overnight? US durable goods orders, bar one of the FOMC members will speak. We've also got consumer confidence, Richmond Manufacturing Index coming through. And in terms of the day ahead, Australian CPI, the cash rate decision from the RBNZ, followed by a press conference. Also earnings from Flight Centre, Worley, Neuron, Fortescue, Beach, Telstra and Woolies will trade ex-dividend. All right, let's have a quick look at where the market is. The CPO looking better than the ASX 200 for sure. It's up 1/3%, whereas the ASX 200 is only up 10 points, or about 0.1%. If I just have a quick look at the movers in terms of the overall gain on the ASX 200, virtually unchanged over the last 5 days and the year to date. I reckon we could just say that every single day. It doesn't seem to move very much. So very range bound, as Martin was talking about. You got to look at where the valuations are and whether or not you want to get in. But of course, another very, very busy day on reporting season. We'll have more for you tomorrow as well. Join us from 10 a.m. Eastern.